What everybody wants to know, to get it out of the way, can you acquire shares in the stock market this morning? Once again, you come back double-digit return. Double-digit. Everybody, Abby's wrong. Hey, you know what? We're up 14%, 12 months trailing. Can you buy shares here this morning?
Very selectively and very carefully. You know, the valuation of the S&P 500 is okay, not great. It's basically trading at fair value for the overall market when we take a look at earnings, inflation, interest rates, and so on. So you have to believe that 2019 will be another year of economic expansion and profit gains. But here's the key message, Tom, and that is overall, we are approaching a point of inflection. The really robust growth in GDP and the really robust gains in profits, these are happening right now, and we do expect this to decelerate, and it will be increasingly clear in 2019, and that is sometimes something that does spook the overall market. I'm also concerned about those non-fundamental factors that are so hard to quantify, whether it is the possibility of a trade war or something else untoward on the international front. These are things that could unsettle the markets. I'm more concerned, by the way, about fixed income than I am equities.
So are you expecting, Abby Joseph Cohen, a big correction in fixed income? And how disruptive, how quickly could that come, and how disruptive would that be for the rest of the market?
So, Francine, if we take a look at what's already happened, there has already been a notable rise in interest rates at the intermediate and long end. This flattening of the yield curve has not been good for fixed income portfolio investors unless they've been very careful and cautious, kind of trading around, looking for opportunities in credits and so on. And I think it will be increasingly difficult for fixed income investors to do well. You know, we're looking at global bond markets where government bond yields are negative for more than half of the developed economies. That's not sustainable. In the United States, we have already seen a rise in the 10-year Treasury yield to 3%. Can it go higher? We think it will, 3.6% by the end of next year. So we would be cautious in fixed income. It's not a large enough increase in interest rates to really damage the economy substantially, but it can hurt fixed income portfolios.
What are the chances of a trade war at this point escalating? So you talk, I guess, about a cyclical downturn, which would mean that, for example, the U.S. economy, would slow down a little bit. But if you compound, what's the possibility of something ugly coming out of geopolitics?
It's very hard for me as a financial analyst to assess those probabilities. What we can try to do is determine what the damage would be if that were to occur. And it's obviously not a pretty picture. At one level, demand for U.S. product would be slightly affected. Keep in mind that the United States has enjoyed enormous growth in exports, but it is still a small percentage relatively of our GDP. What we're concerned about, and what is so hard to quantify, is what's the impact not just on demand, but on cost and on supply chain disruption. And we're already beginning to see that. What we have now are anecdotes more than anything else, but we think this is what we need to be watching. Clearly, if there were an all-out trade war, it will be very difficult for investors to focus very directly just on the fundamentals. The geopolitical environment will be uncomfortable. And one more thing, and that is flows of funds internationally. The United States benefits tremendously from non-U.S. investor demand in U.S. securities, not just the treasuries, but also equities. And over the last year or two or three, the significant demand in U.S. equities has come from the countries where the president is now talking about slapping significant tariffs. That can't make those investors particularly friendly towards the United States.